Now, this is what you need to do when the stock market is crashing. Now, first of all, you need to mentally prepare yourself that the stock market crashing is something that will happen. The stock market has crashed before in the past numerous times, and it will happen again. So, mentally preparing yourself that this can happen at any time, that's the first thing that you need to do. Second thing is, if you are an investor who's close to retirement age, your investments don't need to be in high risk, high volatile stocks anyway. Your investments need to be in safe, fixed income assets such as cash, money market accounts, bonds, annuities. And when you look at your asset allocation, maybe a small percentage can be in those high volatile stocks. Now, a stock market crash is when the stock market sees a swift and brutal decline in many different industries and sectors. Now, a stock market crash should not be confused with a stock market correction, which is when the stock market has been overvalued and it needs to be corrected. Stock market corrections happen numerous times, all the time, and they don't take that long. Now, a stock market crash is when everything goes haywire. You will see people talking about it on the news. People will be selling their shares. People will sell their stocks. People will generally be in a bad mood. Now, stock market crash can also happen for many different things. The most recent one we had in 2008, or one that we had in 2008, was the housing market crash. And then the one we had in the 2000 was the dot-com crash. And as an investor, if you are investing in the stock market, one thing that comes into play is dollar cost averaging. This, especially if you're investing in a 401k, dollar cost averaging means that you're taking a specific amount of money and you're constantly investing that same amount of money over a period of time. So you're buying shares of stock when they're selling at a high price and you're buying them when they're selling at a discount, which averages everything out. That's why it's called dollar cost averaging. If you're somebody who participates in a 401k, you are automatically dollar cost averaging. So with dollar cost averaging, you're investing through the good times and the bad times, pretty much taking emotions out of it, which will end up benefiting you in the end. Now think about it like this. While the stock market is crashing and a lot of people are selling and losing money, there are investors that see this moment as a opportunity because you have all these high quality companies that are selling at a discount. It's like going to the store. If you're a kid, you go to a candy store and you see all the candy is like 50% to 60% off. So, yes, while people are selling and losing money in a stock market crash, there are value investors and income investors that wait for these moments so they can buy the companies and the shares in these companies at a discount. And so, for example, let's say you want to buy Coca-Cola. Coca-Cola is, for example, trading regularly, they trade $50 a share. And you have $500 to spend. So that means you can buy 10 shares in Coke. But in a stock market crash, let's say it was a bad stock market crash, the stock market dipped and Coke is selling for $25. Now you can buy 20 shares. So previously at $50, you could buy only 10 shares. But now that the stock dipped down to $25, for that 500 bucks, you can buy 20 shares. This is a technique that a lot of income investors use. And me being a dividend investor myself, that's also one technique that I use. Now let's go a little bit deeper into dividend investing. But let me talk about the capital gains and then I'll tie it into dividend investing. So another example, bought stock in Coke at $50 and I bought 100 shares. So my investment is worth $5,000. After a couple of days, the Coke stock, the price of Coke, it got up to $60. So now my investment of 100 shares is worth $6,000. I'm happy, awesome. I ended up selling at $6,000, so I made a quick $1,000 profit. I might have to pay taxes on it depending on which investment account I was investing in. So that $1,000 is going to be my realized capital gain. Now, the reverse might also happen. So I might buy Coke at $50, 100 shares. My investment is worth $5,000. But then after a couple of days, the stock price of Coke dips down to $45. Now my $5,000 investment is only worth $4,500. I panic, I sell at a loss, so I'm $500 at a loss. This is my capital loss, my realized capital loss. Now, let's say going into dividend investing, let's say I bought those 100 shares at $50. Coke pays about 41 cents every quarter in dividend income. 1 quarter times 4, 1 year is 164. I bought 100 shares. So when it comes to income, I make $164 in income with those 100 shares per year. Because think about it, that 41 cents per quarter is for one share. So times 4 is 164 for one share, but I have 100 shares. So I would make $164 just for holding the Coke stock in my account. And that dividend income gets deposited into my brokerage account. I can then decide what to do with it. I might take it out and spend it to buy whatever I want to buy. Maybe I want to buy underwear, I can buy underwear. Or I can take that income and reinvest it back into buying more shares and even fractional shares in Coke. Or I can take that dividend income and I can purchase other shares. That's the way I invest. That's the way I like to invest. And also, Coke doesn't keep their dividend price at 41 cents a quarter. They also increase it based on how they performed. They usually increase it by 5 to 10% per year. And then also, I like to invest more of my money into buying those dividend paying companies, especially in times of economic turmoil. Or I should say, my money actually goes longer because instead of buying 100 shares at $50, if I have $5,000 to spend, I can buy 200 shares if Coke dipped down to $25. So 200 shares would give me not $164 in income, in dividend income. It would actually give me $328 in dividend income. Now, for example, here are four companies that pay a dividend. You got Nike, Pepsi, McDonald's, Coca-Cola, and I'll give you one more. Realty Income, they pay a monthly dividend. So most companies in the US pay a quarterly dividend every 3 months, but Realty Income is a company that pays a real estate investment trust. They pay a monthly dividend. So, whenever you're reading a news article about the stock market, or you might be watching the newscaster might say something like, the stock market was down X amount of points. So, for example, they might say the S&P 500 or the Dow Jones was down 200 points. 1 point is $1. So when they say 200 points, they mean the stock market was down $200. Now, that in itself doesn't tell me too much because the stock market always goes up and down. One thing that I like to do is I like to put it in perspective by looking at a larger time frame. One thing that I do, of course, is to come to this website, Financial Visualizations, finfis.com, and if you click on futures, and then you click on the S&P 500. Now the S&P 500 of course consists of the 500 largest companies in the US. It's a great way to track what the economy is doing overall. Let me increase the date range to the maximum. So looking at a larger time frame and not just looking at it day by day, because of course the market is always going to swing up and down. You can see that of course in 2000 we had the dot-com bubble crash, and then we had the housing market crash in 2008. So just quickly looking at the chart, you can see in the 2000s, The S&P 500 was trading at its highest almost at 1600 points, and then it dropped down all the way down to a little under 800 points, $800. And then we've been able to recover, and but then in 2008 the housing market crash. Looking at how the S&P 500 was trading, you can see that it was almost close to 1600 points again, but then it crashed all the way down to almost to 600 points this time. But ever since then, we've been able to pick up, and the stock market did extremely well. There has been some turbulence, but comparing it to 2000 and 2008, we've increased tremendously. So definitely come to this website. This website gets updated frequently, so it's always going to have the up-to-date information. Of course, you can also log into your brokerage account and do some technical analysis to get all this data. But if you do not want to log into your brokerage account, or if you don't have one, you can always come to this website and just see how the S&P 500 is trending.